Most people hear about the stock market, but very few actually understand how it works. Before you invest, you need to know the basics, the real meaning behind the terms you hear every day. In this video, you'll understand the stock market in the simplest way possible. Let's begin. 1. Stocks and shares. When you buy a stock, you don't just buy a number on a screen. You buy a tiny piece of ownership in a company. If a company is like a giant pizza, each slice represents a share. The more slices you hold, the more ownership you have. 2. The stock market. The stock market is simply a place where people buy and sell pieces of ownership in companies. Around the world, these trades happen on major exchanges, like the New York Stock Exchange, NASDAQ, the London Stock Exchange, or Tokyo Stock Exchange. Each country has its own version, but the idea is always the same. People exchanging belief in a company's future for a price today. 3. IPO. Initial public offering. This is when a private company decides to go public. It's the first time everyday investors can own a slice of that business. Think of it as a company opening its doors to the world. 4. Brokerage account. To participate, you need a digital broker, an online platform that connects you to the market, and an account to safely hold your shares. 5. Ticker symbol. Every stock is identified by a short code, like Apple for Apple, or Tesla for Tesla. It's the market's shorthand for every company on Earth. 6. Demand and supply. Stock prices don't move randomly. They move because people do. When more people want to buy than sell, prices rise. When more want to sell than buy, prices fall. Every price you see is a reflection of collective human emotion, greed and fear, hope and panic. 7. Market capitalization. Market cap tells you how valuable a company is, at least in the eyes of investors. It's calculated as share price times total shares. If each share costs $100 and there are 10 million shares, the company's market cap is $1 billion. 8. Volume. Volume means activity. How many shares were traded in a day? High volume means attention. Low volume means silence. 9. Volatility. Volatility shows how fast prices move up and down. Some investors love it. Others fear it. It's the heartbeat of the market. Sometimes calm, sometimes chaotic. 10. Bull market. When prices rise consistently and confidence grows, that's a bull market. The bull charges forward, symbolizing strength and optimism. 11. Bear market. When prices fall over time and fear dominates, that's a bear market. The bear swipes downward, slow, heavy, and uncertain. 12. Investor versus trader. An investor believes in time. A trader believes in timing. Both play the same game, but with different clocks. 13. Portfolio. Your portfolio is the collection of all your investments, your personal financial fingerprint. 14. Diversification. Diversification means not betting everything on one idea. It's how you survive when others don't. 15. Earnings per share EPS. EPS tells you how much profit a company makes for each share you own. Higher EPS means more profit per slice of a company. 16. Price-to-earnings ratio, PE. One of the most watched numbers in finance. PE equals share price divided by earnings per share. A high P means investors expect big growth ahead. A low P means the stock is undervalued, or that investors don't believe in its future. 17. Dividend. Some companies share a part of their profit with shareholders. That payment is called a dividend. It's a small thank you for holding their stock. 18. Dividend yield. Dividend yield shows how much income a stock gives you, not just how much its price changes. It's the percentage of return you earn from dividends alone. 19. Book value. Book value represents a company's net worth on paper. It's total assets minus its debts. 20. Market value versus book value. Market value is what people think a company is worth. Book value is what it's actually worth on paper. The gap between them Shows how much the market believes in that company's story. 21. Index. An index tracks a group of companies to show the direction of the market, like the S&P 500, NASDAQ, or Nikkei 225. It's a snapshot of overall market health. 22. ETF, Exchange Traded Fund. An ETF is like buying a mini portfolio, a basket of many stocks, but traded as one. 23. Mutual fund. Similar idea, but managed by professionals who pick where your money goes. 24. Liquidity. Liquidity means how easily you can buy or sell something without affecting its price. Apple stock is liquid. Rare, art is not. 25. Stop loss order. A stop loss is your safety net. You set a limit, so your stock automatically sells if it drops too much. 26. Limit order. You tell your broker the exact price you want to buy or sell. The trade happens only at that price. 27. Market cap categories. Not all stocks are created equal. Large cap stocks are massive and stable. Mid cap stocks balance growth and risk. Small cap stocks are high risk, high reward. 28. Blue chip stocks. These are the giants. Trusted companies that survive crises and grow steadily for decades. 29. Penny stocks. Tiny, low-price stocks. They can multiply fast or disappear just as quickly. 30. Volatility Index, the VIX. The VIX measures fear. When it rises, investors are nervous. When it falls, confidence returns. 31. Short selling. Short selling means profiting when prices fall. You borrow a stock, sell it high, and buy it back cheaper later. Risky, but powerful. 32. Leverage. Leverage means using borrowed money to invest more. It multiplies both gains and losses. Used wisely, it's a tool. Used carelessly, it's a trap.